These niggas pop, my money keep growing. Your girl is a dot, she all on my groin. She blowing my horn, we fucking porn. These rappers is whack, they lyrics is corn. I'm getting this money, it never get born. I'm loading my strap, they calling law. Fuck around and you clap for running your jaw. If it ain't about the dollars and it don't make sense. Got me sipping brown water, but it ain't from Flint. Trying to chase all this bread, though the shit won't last. About to shut the city down like a crypto crash.
Yo, it's crypto blood, Detroit flow, screaming from the D, knowing what to show. Indicators are wrong point, OG since 12, invested in trade, living life like a pro. I'm Rucker, Jerry, it's just blood too. Bad motherfucker, but in a good way, boo. Got my eyes on the charts, ain't no time to sleep. Get that money, gotta keep it creep. That's my crypto blood, Twisted Toasters on the line. Stacking my coin, got the market on my mind. Bitcoin, Litecoin, Ethereum too. Cash is king, but I'm looking for a new move. I know the culture of the markets like the streets. Got my finger on the pulse, can't nobody beat. I see the trends, I see the flow. Got my strategies in place, you know.
Do it live! I'll write it and we'll do it live!
Okay. Ready?
Fucking thing sucks! We'll do it live.
That's right, ladies and gents, we're doing it live. Welcome to an FOMC rate decision live stream with yours truly, Crypto Blood. Let's get some rounds of applause. Let's get some thumbs up. Let's get some salutes like House of Trades. We got a raid coming in from Trade Intuition crew. Thanks for tuning in, guys. Appreciate it. We're gonna get Trade Intuition on later this week, hopefully. So thank you all for tuning in. We got a rate decision. I mean, it's pretty much known what's going to happen here, but a quarter basis point is coming. I don't think anything more or less. But what is the verbiage? What is the language going to sound like coming from Jerome Powell at 2:30? That's what we really want to find out, and that will really move the markets, in my opinion. So let's get over here to CNBC and check out what they're talking about, and then we'll talk about yesterday's trade. Boy, I tore him up yesterday, baby. I hope you did too. We went short and we caught all of that. We'll take a look at that in a minute. Let's go.
The 4.3% that we last got based on some of the private market surveys. So I think the Fed is very wary about that, and that probably puts a couple more rate cuts in front of them.
All right. Now, Francis, if we turn towards you, there have been allusions now from both of our guests here on the panel with regard to kind of what other data points might be at play. From your standpoint, what were you looking at over the course of the last few weeks in the absence of any official government data coming out, ex the CPI print we got last week?
Quantitative data from the private sector and also some qualitative data from the beige book. But that's exactly what I want to hear from Powell today is we have a sense of what their decision-making function is, but what are they going to be reacting to? Because this isn't just about 1 month of lost data. We're going to have several months here where the data is going to be very skewed, very difficult to get a core read, especially on the inflation side. That's really hard to look backwards on until where we were 3 months ago. So I want to hear from Powell today. This is what we're going to be looking at, not just how we're going to be reacting to the economy ahead.
Now, Francis, one quick point here before we get to that decision. From a data standpoint, do you feel constructive about what the economy is doing right now as we head into this print?
No, this is what we call stagflation light type of environment. It is growth below comfort level, and it is certainly inflation above comfort level. I don't know what the Fed's trying to achieve with these rate cuts here, maybe not being as restrictive, but a lot of the job weakness that we've seen is that low hiring, low firing results from a trade shock that's coming through. Right. I'm not sure that these rate cuts that we're seeing from the Fed is going to cure what ails the American economy.
All right, Francis, hold it right there. Let's get out to Steve Leisman for the big rate decision. Steve.
The Federal Reserve cutting interest rates by a quarter point to a new range of 3.75 to 4%. There were two dissents on this. The second one by new Fed Governor Myron, who wanted 50. First one by Kansas City Fed President Jeff Smith, who wanted no change. So dissents on both sides, a kind of a rare occurrence for the Fed. The Federal Reserve announcing it is stopping quantitative tightening or the roll-off of its balance sheet as soon as December. All roll-offs of treasuries from here on out and mortgage-backed securities on the Fed's balance sheet will now be invested into T-bills. It's a bit of a change there. On the economy, the Fed said economic activity expanded at a moderate pace, according to available indicators, one of two nods in the statement to the absence of data by the Federal Reserve. It had said in September that the economy was moderating, so almost a bit of an upgrade to the economy, but according to available data. Job gains, it said, has slowed, however. Unemployment remained low through August. And again, it said more recent indicators are consistent with these developments. That's another nod to the idea that the Fed doesn't really have the official data. More recent indicators is what it's using. Inflation, it says, has moved up since earlier this year and remains somewhat elevated. That is the same characterization as September. And there's not much in the way of forecasting the future path of rates. I believe that'll have to wait for the press conference from Fed Chair Powell. But again, the Fed cutting by a quarter, two dissents on both sides of the issue. One wanted more, one wanted none at all, and the Fed stopping quantitative tightening as of December. Guys?
All right, Steve Leisman, please stick around here. Let's get back to our panel for some reaction here. Jim, I'm going to start with you first. We showed the charts of the market reaction. Equity markets have been relatively stable as they were going into this print. The curve from the 2-year all the way to the 30 have moved maybe higher by anywhere from what I could see 1 to 3 basis points. This is all about the Fed rate press conference now at this point. But what stood out to you from hearing what you heard from Steve and then what you saw or didn't see from the market reaction?
So that's a great question. So I think that.
All right, guys. So we'll fade that back. Look at the markets really quickly. I got to show you yesterday's trade. Phenomenal trade. I don't know if you guys followed me into that short on Ethereum yesterday, but let's take a look at it. Powered by Bloodalytics, of course. Round of applause. You can always sign up at bloodalytics.com to get these types of insights on trade directions. Yesterday, we went short on Ethereum. I don't know if you guys recall that trade. I'll bring up the receipts in a second. Let me just get out of this full screen. And we went short during our stream. Actually before the stream. I think after the stream. I went short on Bitcoin or Ethereum, I should say, after we went live. Caught a little above entry point, and we toggled once. And then we went back short, and you should have, if you have Bloodalytics, you definitely would have caught this one at 2:30 p.m. Eastern Standard. This short right here took us all the way down. All this money right here, baby boy, baby boy. I should probably share the stream, the chart, right? Let's try that again. So we went short after the stream at about I think like 11:15-ish. We got in above entry on this short, which is always a favorable position to be in. We went long here. This is well after the live stream from yesterday, but you should have caught it if you're a Bloodalytics member. You would have caught that short at 2:30 p.m. Eastern Standard yesterday, which took us all the way downtown James Brown, baby. That would have took you all the way there, my friend. So what I'm talking about, well, this short right here. Yesterday, we went short. Let me pull this up. Made about 5K yesterday on the Bitcoin, on the Ethereum short. Bada boom, bada bing. 5K on that bad boy. All right. And then another $700 and almost $800 on the Bitcoin short. Yes, sir. We trade to win, baby. We trade to win. So almost a 6K day just yesterday. Good numbers for me. I don't know about you. So that's right, man. Smash that like button. Bloodalytics print money like my guy. House of Trade says it. That's right. All right. So we're currently in a long position right now on Ethereum. We'll take a look at that in a minute, but I just wanted to go over that trade from yesterday. Huge trade, caught the whole swing down. Why did we drop? I really don't have any news. I'm not sure why we saw the drop in the markets, but maybe it was a pullback for preparation on a move up on FOMC day. That happens many times as well. You see the markets reposition kind of before the news comes out and then goes back up on the way after the news. Is, you know, sell the rumor, buy the news, a reversal type situation. And that happens sometimes. Rarely does it happen, but sometimes it does happen that way. So that's what we got going on right now. We are long Bitcoin. You could get in this trade right now. We're long Ethereum. We're not quite long Bitcoin. Still in the short from Tuesday. You would have still been in that short. I closed out the short from yesterday on Bitcoin when I closed out the Ethereum short. I said, that's, you know, that's good enough. That's good money for us today. All right. So I just closed that out. But if I would have kept it open, you definitely would have seen even more gains on the Bitcoin short as well, complimentary of Bloodalytics. But Ethereum, we are below entry on the long for Ethereum. A couple of weeks down here to try to stop us out. But this is why it's important. I like seeing this right here. This is a great illustration. This is why it's important to have your stop losses. Well, first of all, I would probably suggest not trading during FOMC. It's just too much wick action going on, to be honest with you. I do it because, but I don't trade a lot as far as amount, because the wick action is diabolical. As you see, this is our soft stop loss area, and we clearly ran all the way through that, down about 0.2% lower than the stop loss. So if you had a stop loss even hiding maybe 1% below, 0.1% below, you probably would have gotten stopped out. Not on this one, but this second candle on this 1 minute candle here, you would have got stopped out. And it looks like we're heading back towards that area right now. So volatile periods, and you got to kind of have your stop losses very wide if you're going to trade FOMC, and I would trade smaller amounts than you normally would, just in case, because it will wick around. It will stop a lot of people out before the real direction is set in. Before we go any further, listen, I need you to hit that like button. Follow me on X right now. Follow me on YouTube as well. If you're watching on YouTube, hit that subscribe button for me really quickly. Bloodalytics in full effect. It just shows you the short that we did yesterday on Ethereum and Bitcoin, raking in a good 5 G's on the Ethereum short and another 800 on the Bitcoin short from yesterday. All complimentary of Bloodalytics, ladies and gentlemen. Bloodalytics at it again. This is Scalpalytics Pro here, Bitcoin and Ethereum. Check it out, the bloodalytics.com. All right, check it out, check it out, check it out, check it out. We also have Solana BNB and SUI XRP. I suggest trading this signal during US time zone, potentially even Euro, but not Asia. I wouldn't trade the Asian zone with this signal. It's best during 9:30, right when the market's open. You can trade it up until close, but you should have a winning trade by the end of the day. It happens sometimes where we don't. We get a back and forth flop city, flopping and groping. That happens from time to time for sure. That's just part of trading. Can't win every day, but we win most days over here at Bloodalytics, ladies and gents. If you trade it the right way, if you use the system the right way. All right, I want to also look at really quickly October, or Uptober is what they want to call it. We're down right now on Bitcoin 1.78%. Now, remember yesterday I was telling you this might be a good zone for you to start buying and bidding the way market back up for maybe Friday of a close on October in a strong manner, at least in the green. Even more of a reason to potentially buy the dip and play the whole odds of October, right? We've only seen 2 negative months in October. And when we had a negative month, at least the last one we had, which was all the way back in 2018, guess what? December was abysmal. Now, that's not enough to call, some type of trend or pattern there. I don't even count. Well, 2014, we had a negative 12%, almost 13%. And then the next month we had a positive 12%. So a wash of those 2 months. But we definitely have November has more red days than October. October has historically been a very strong month for Bitcoin and the stock and the cryptos. So I don't know. Let's take a look at Ethereum and see what's going on. I never looked at Ethereum's streak. So Ethereum, I would say, is probably, we're going to go back to 17. We don't have as many years, but 17, February seems to be the best month. I'm just looking at the average and median down here really quickly. I'm going to not include the first year. Well, we take a look at, we got April. April looks like the best. No, the median for May seems to be the best month for Ethereum. Yeah, 18% by a long shot. That's the best. So May is usually Ethereum's best month, but October is Bitcoin's best month by far. And we are negative right now. So hopefully we can turn that around. We can get some action to the upside. And what I'm gonna do right now, though, I'm seeing that we are down in our Ethereum long. Let me just double check the charts really quickly on Scalpalytics Pro and see. So yeah, we're getting close to the stop loss again. I'm gonna add to my position just a tad bit. See if we can defend that trend. I just added a little bit more to that trade. And what I'm going to do right now is hide. I'm going to hide the stop loss on this trade below that wick, that previous wick right here. Hide it behind here. So let's see what we got here. Because I'm not trusting these stop losses right now during FOMC. So I'm gonna hide it down 0.25% lower than 0.28% lower than where we are. And then if we get below this area, I'll just go short, because we got a short signal on Ethereum with Scalpalytics Pro right now, but I'm not trusting that because of the volatility. So I'm just gonna hide this right here. Copy. Put our stop loss in, and if we lose, oh well, that's part of the game. So if we lose, I'm losing about $700 on this trade. If we get wicked out, if we go below the wick, I'm cool with that. Yesterday was a good day, so I'm cool with that. So that's where we are. I know we have a short on deck right now with Scalpalytics Pro, but I'm not yet convinced. So we're going to see if the markets will push us below this region right here, this wick. If we get below that, then I'll know it's potentially a true move back down, but I'm not buying it yet, ladies and gents. And this is probably the only time where I would go against the signal, is in very whipsaw-ish, volatile time periods where we have news like FOMC. That's probably the only time I would not always follow the signal. But that just takes some time in the markets to understand that. So that's why you're here. All right. Centino Monero says, shake out before we go up. I think so. Santino. I really do. We had a huge move down yesterday. I mean, from triggering our short on Bloodalytics, we went down. We got down. We dropped almost 4.5% in one day. That's a big move for crypto nowadays. That's a big move for crypto. So that was a big move. Again, I think it was a move to take us down so we can go up on today. That's what I feel. And we can end the week strong and have an October in the green. If we don't close in the green for October, I would be a little concerned. I would definitely be a little concerned. Now, if we take a look at the macro chart, I'll keep that one up. We'll go over here for the macro chart. Take a look at the macro chart. There are some things that are concerning right now, I will have to say. The main thing that's concerning is that we did not get above the rejection point. Those two A's over there to the left, over here. Remember I said, we got one more area that we need to get above. I thought we had a clear path to 120. Then I said, nope, not the case. We have to get above 116, and we failed twice. You could potentially say 3 times, but I'm just going to go with 2. I'll go with this one, and I'll go with this one. Slight attempt here, but I'm not going to count that. I'm not going to count that. So 1, 2, 3 strikes. Are we going to go back up and try again? 3 strikes, you're out? I don't know. I don't know. You guys let me know your thoughts about that. But it is definitely some resistance ahead up at 116. And we were not able to successfully breach that and keep that line and make that resistance. Support, I should say. Previous resistance becomes future support. We weren't able to do that. Let's check on our Ethereum long. We doubled down on that trade, and it is paying benefits right now. Up about $200 on that trade. I went counter the signal, Bloodalytics Scalpalytics signal today, just because we're FOMCing it. Hit my stop loss below the wick. We go back below there. That's true conviction on the bear side. So that's why I went ahead and added to my position and hit my stop loss below this wick. Okay. So we'll see how that plays out. We'll jump over to CNBC in about 10 minutes. Hit that like button again, ladies and gents. Thanks for tuning in to the stream. I really appreciate it. Shout out to BYDeFi. We're trading over there. Shout out to MGBX. We're trading over there as well. Link in the description for both of those. Blowfin is where we auto trade. So 3 magnificent, fantastic. I don't know what other superlative I want to use. Great exchanges. I'll tell you that much. 3 great exchanges. So definitely hit that link in the description below for MGBX. I'll be streaming on their account, their corporate account, Friday. Come join me. Weekly recap. We're going to start doing that every Friday, 4 p.m. Eastern Standard Time, over on MGBX_EN, their English account on Twitter. I'll be there. So come join me for that. That should be great. We'll have some special guests coming in on that day. And then, of course, we can't forget, as I stated, BYDeFi. Kind of going back down. What's going on? Do I have to add some more? Add a little bit more. Just a little bit, not too much. Bring that dollar cost average down a little bit more. We got our stop loss in. If it takes us out, it takes us out. But they got to show me. The bears got to show and prove. The bears got to run us back below that wick. See, when you see long wicks like that, even though this is on the 1 minute, when you see long wicks like that, that's showing conviction from the opposite team. So a wick that's below the candle, and we see it wick back up, that shows conviction by the bulls. And then if we see a wick above the candle, that shows that the bears are taking over, and the bulls could not further the goalpost. They couldn't further the ball down the field, right? They got rejected. So that's why it's cool, even on the 1 minute, to hide them behind those long wicks like that. It can tell you something for sure. So we'll monitor that. We got about 8 minutes. Hopefully down now means up in 10 minutes. David. Hey, Dave, go check out my video from yesterday. I actually highlighted your tweet that you added me and a few others on from a person that was talking about the manipulation in the markets. I want you to go back and watch that if you missed it in my live stream yesterday, because and I don't know what the marker was. It was toward the middle or tail end of the live stream. So go back and check it out. I think you may enjoy my 2 Satoshis on that individual's assessment of October 10th. So, but it is looking, I'm gonna be honest with you, that move down was a little like kind of came out of nowhere, right? So again, it could have been just a repositioning of the market, bigger players to kind of wash out people below and then accumulate at a lower price and start heading back higher after FOMC. That's what I'm thinking. But who am I? I don't know. PD Pablo? I don't know. I mean, just my opinion. And everybody's got one. So, stock market still holding up pretty well. This is one day out of very few days where we see the NASDAQ up 0.5%, and we got the crypto markets down. So, slight divergence going on. Greed fear index is now at 39. Yesterday we were looking at it. It was what, at 42, 43, somewhere around there. And overnight, let's see, yesterday we were at 42. Yesterday we were at 42. But we're dipping back into the fear range, the top range of the fear area, 39. So can't really say. Last week we were in at 29. We were pretty low last week. Again, that would have been probably a good area to go ahead and start nibbling a little bit for sure. Anything below 20 is just like you gotta buy. Just on GP, you just gotta buy some. Gotta buy a little bit. What's S.AF? So let me see what we got for the rest of the week. I don't think we have anything really to look out for. We got Powell speaking at 2:30. Tomorrow, what do we have? Tomorrow we have nothing. And Friday, nothing. So we should be clear. After today, we should be clear to go whichever direction we're going to go for the rest of the week to close out October or Uptober. Hopefully it's Uptober. Hopefully it's Uptober for you. But we are a long way from Kansas, meaning, you know, we zoom out here and look, man, we got a hell of a way to go to get back to all-time highs. And I'm telling you that 12% away, not looking good. Not looking good, guys. It's not looking good. When things in the top 100 fall 40 to 50% lower than their previous all-time lows since 2020, lower than even their inception price, and lowest bear market lows, that's shady as hell. Okay, I got you. Potentially, but at the same time, this is what happens when you have low liquidity or low liquid markets. Bitcoin and crypto, it really doesn't. The order books are actually quite thin. So if anyone panic sells, or you have more than one party that panic sells, and you got Wall Street in this bad boy now, you know, they got big order books. You can see literally gap downs or super wicks like we saw on 1010. You know, it's very possible. So from a market structure perspective, I'm not shocked at that wick down, you know, because these order books really aren't that thick. They really aren't. So it doesn't surprise me, David. It does not surprise me. So we got November coming up, ladies and gents. How do you think November is going to weigh out for us this year in 2025? I personally think it's all predicated on what Trump does. It's all predicated on what Trump and the geopolitical China, all that stuff plays so much of a factor. You can't just simply say, oh, I think November is going to go up or be up because XYZ happened in the past, because we had a 37% up November in 2024 or 42% in 2020, 50%. None of that matters, because in those years we didn't have the things that we're dealing with geopolitically how we are this year. So we can't even compare. It's like comparing apples to oranges. We cannot compare last year or the year before that. We got to go on what we have going on right now, and it's a lot of geopolitical stress and tension between China, Russia, U.S., even Israel, the small hats out there, about to strike Gaza again, basically completely break their ceasefire, their truce. We knew that was going to happen. It was just a matter of time. You know, they'd be itching to have war in the name of Holocaust survivors. So we were just waiting. We didn't know when, but we knew it was going to happen. So Israel striking Gaza, or I saw earlier today, they were given orders by Benjamin Netanyahu to go ahead and strike the Gaza Strip yet again. So horrible, man. Absolutely. This guy needs to be eliminated, probably, or thrown out at least, because they're already trying to put him in jail. His own country is looking to put him in jail for crime wars. So this is why he continues to perpetuate these strikes, so that he stays in power. This is what he's doing, why he's doing this. Let's get back over to CNBC and see what Jerome Powell got to say.
Early to you to be cutting rates, he's probably on time.
All right, so we've got a little balance here. Richard, I'll give you the final word. Your final thoughts before Fed Chair Jerome Powell takes the podium.
Remember, monetary policy, we used to think that it would take 18 months to have its impact. I think the period's much shorter now, but there is a variable rate of time that it takes for these decisions to actually hit the economy. The markets react almost instantaneously, right or wrong. But I thought that was a very good point. And we're just going to have to see how he handles himself here and what he says. And I expect him to be cautious. And the last thing I'll say is this: no Fed chairman has communicated this constantly with the marketplace. Remember, Volcker said nothing. Greenspan talked, but we couldn't understand what he was saying. He was just a great mumbler. And it was only every quarter that you might have gotten, or sometimes only twice a year, from previous chairman. Let's give Jay Powell credit. After every single meeting he meets, he also is open when he talks. And I think that's very important.
I'm telling you, he's prompt. Richard Fisher, I'm going to cut you off right now. Fed Chair Jerome Powell is taking the podium as we speak.
We're going to go to another screen.
Although some important federal government data have been delayed due to the shutdown, the public and private sector data that have remained available suggests that the outlook for employment and inflation has not changed much since our meeting in September. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals and in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point. We also decided to conclude the reduction of our aggregate securities holdings as of December 1. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available prior to the shutdown show that growth in economic activity may be on a somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains weak. The shutdown of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months ending in September, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 3.75% to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside. A challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. With downside risks to employment having increased in recent months, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. We continue to face two-sided risks. In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course. At today's meeting, the committee also decided to conclude the reduction of our aggregate securities holdings as of December 1. Our long-stated plan has been to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserve conditions. Signs have clearly emerged that we have reached that standard. In money markets, repo rates have moved up relative to our administered rates, and we have seen more notable pressures on selected dates, along with more use of our standing repo facility. In addition, the effective federal funds rate has begun to move up relative to the rate of interest on reserve balances. These developments are what we expected to see as the size of our balance sheet declined and warrant today's decision to cease runoff. Over the 3.5 years that we've been shrinking our balance sheet, our securities holdings have declined by $2.2 trillion. As a share of nominal GDP, our balance sheet has fallen from 35% to about 21%. In December, we'll enter the next phase of our normalization plans by holding the size of our balance sheet steady for a time, while reserve balances continue to move gradually lower as other non-reserve liabilities, such as currency, keep growing. We will continue to allow agency securities to run off our balance sheet, and will reinvest the proceeds from those securities in Treasury bills, furthering progress toward a portfolio consisting primarily of Treasury securities. This reinvestment strategy will also help move the weighted average maturity of our portfolio closer to that of the outstanding stock of Treasury securities, thus furthering the normalization of the composition of our balance sheet. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting our maximum employment, bringing our inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, are you uncomfortable with how market pricing has assumed a rate cut is a foregone conclusion at your next meeting?
Well, as I just mentioned, a further reduction in the policy rate at the December meeting is not a foregone conclusion, as I've just said. So I would say that that needs to be taken on board. We had, I would just say this, 19 participants on the committee. Everyone works very hard at this and takes their obligations to serve the American people very seriously. And at a time when we have tension between our two goals, we have, strong views across the committee. And as I mentioned, there were strongly differing views today. And the takeaway from that is that we haven't made a decision about December. And, we're going to be looking at the data that we have, how that affects the outlook and the balance of risks. And I'll just say that.
You and some of your colleagues have framed last month and maybe today, I won't put words in your mouth, there's a risk management exercise. At what point do you conclude that you've taken out enough insurance? Are you looking for some kind of improvement in the outlook, or could this unfold along the lines of last year, where you made a sequence of adjustments and then waited to gather more information?
So the way I've been thinking about it is the risks to the two goals. For a very long time, the risk was clearly of higher inflation. And then that has changed now. And as we saw particularly after the July meeting, we saw the downward revisions in job creation, we saw a very different picture of the labor market, and suggested that there were higher downside risks to the labor market than we had thought. And that suggested that policy, which we had been holding at a I would say modestly, others people would say moderately restrictive level, needed to move more in the direction over time of neutral. If the two goals are sort of equally at risk, then you ought to be at neutral, because one of them's calling for you to hike and one of them's calling for you to cut. So if that got back into balance, then you'd want to be roughly at neutral. So in that sense, it was a risk management And I would say the same about today, sort of the same logic. But as I mentioned, going forward is a different thing.
Claire. Claire Jones, Financial Times. Thank you for taking this question. We've just heard from you that the discussion in December and the conclusion of the discussion is not a foregone conclusion. I'd like to just dig into that a little bit more about what sort of arguments were brought up. Was there any consideration, for instance, of the investment we're seeing in AI and some of the generation of household wealth through rises in stock prices related to the AI boom? Thank you.
I wouldn't say that's a factor in everyone's assessment of the economy. I wouldn't say it's the driving factor. I don't think for anybody. I guess I would say it this way. Once again, I would just point out that we have the situation where the risks are to the upside for inflation and to the downside for employment. We have one tool. It can't do both of those. You can't address both of those at once. You've got a very different situation. So you have some people have different forecasts, right? So they'll forecast faster or slower progress on one or the other, and they also have different levels of risk aversion. And some will be more averse to inflation overruns, and some will be more averse to underruns of employment. And so you put that together, and as you can see from the SEP and from the public discussion that goes on between the meetings when participants go out and talk, they're very disparate views, and they were reflected in strongly differing views in today's meeting, as I pointed out in my remarks. And that's what leads me to say that, that we haven't made a decision about December. I always say that. It's a fact that we don't make decisions in advance. But I'm saying something in addition here, is that it's not to be seen as a foregone conclusion. In fact, far from it.
Can I just ask a quick follow-up on QT? How much of the fund impressions we've seen in money markets are related to the US Treasury issuing more short-term debt?
That could be one of the factors, but the reality is we've seen, the things that we've seen, higher repo rates and federal funds rate moving up. These are the very things that we look for. We actually have a framework for looking at, what the place we're trying to reach. What we said for a long time now is that when we feel like we're a bit above what we consider a level that's ample, that we would freeze the size of the balance sheet. Of course, reserves will continue to decline from that point forward as non-reserve liabilities grow. So this happened, some things have been happening for some time now, showing a gradual tightening in money market conditions. Really in the last, call it 3 weeks or so, you've seen more significant tightening, and I think a clear assessment that we're at that place. The other thing is, the balance sheet is shrinking at a very, very slow pace now. We've reduced it by half twice, and so there's not a lot of benefit to be holding on to get the last few dollars because, again, with the balance sheets, the reserves are going to continue to shrink as non-reserves grow. So, there was support on the committee as we thought about it to go ahead with this and announce effective December 1 that we will be, freezing the size of the balance sheet. And the December 1 date gives the markets a little bit of time to adapt.
Colby.
Thank you. Colby Smith with the New York Times. So much of the rationale for cutting interest rates, even as inflation moves away from the 2% target, seems to be, that there are these mounting downside risks to the labor market. But if those don't materialize and the labor market either stabilizes around current employment levels or even starts to strengthen somewhat, how would that change your perception of how much interest rates need to fall from here? Would you then be a bit more concerned about underlying inflation and the possibility of second-round effects from tariffs?
Yeah, I mean, in principle, if you were to see data that suggested that the labor market's strengthening or even that it's stabilizing, that would certainly play into our decisions going forward. So, we do have, we get some data. The labor market is a place where we get, for example, we get the state level data on initial claims, which are sending.
Just really quickly, just show you. I added another long position in here at a lower price and hid my stop loss yet again under this V. So this was the death blow. The Freddy Krueger candle is on Ethereum. I lost $1,000 on that trade alone, but I was willing to go that strong just because yesterday I made almost 6,000 on shorting Ethereum and Bitcoin. If you guys are late to the live stream, we went short on Bitcoin yesterday and Ethereum, more specifically Ethereum, yesterday at like 2:30 p.m. and caught all of this right here. Chain. So I was willing to get a little Rico reckless with that long there. So we're gonna try it again though. We're going in again. 70K on Ethereum long, hiding that stop right below the last V. And let's see what happens. I mean, at least this time, if I lose, how much would I lose this time? If I lose this time, I'm done. I'm not effing around. 900. Jeez. Man, just entered Bitcoin long 75x. No, I'm not drinking. Trading on the 1 minute high risk. Stop in place. Lower entry in place. There you go, baby. Let's do it. We're gambling at this point. I don't know what the hell can come out of Jerome Powell's mouth. Trading FOMC sucks. I got liquidated too on my Bitcoin long ETH just now. There you go, baby. Let's go, Mastermind. Let's go. Let's pump this bad boy up. Let's get our money back. This is some Rico reckless stuff right here we doing, man. So as you can see on the screen, I'm back in after the dip. Hide your stops below the V, ladies and gents. Hide your stop below the V. And try it again. Rinse and repeat. Rinse and repeat. Just don't bet the house, though. That's the whole. This is where don't bet the house. See, this is where newer amateur traders go wrong. They think they just know it's going to go up. I thought it was going to go up. I was wrong. I could have literally followed Bloodalytics and been Gucci, but I had my reason for thinking that we were going to go higher. So I'm fine with that. My reason was wrong, but I'm fine with that. As long as you're not doing it for no reason at all, you're just guessing, then you're good. Okay, so we're back in it. You know, Bloodalytics was short the whole time. Boom, took it down. Would have made some money right here. All this would have made money, but I decided to go against my own creation. The house is gonna already. The house is going already. Yeah, I hear that, man. I hear that. So we gonna try it again though. Let's try it again. And let's get back to Jerome Puppet, Freddy Cougar, whatever his name is. Peace Smackers. What? I don't know what that name is. Hey, Crypto Bug, glad to hear confirmation from Math that y'all are eventually getting another trading system going together. Hopefully it's tap to trade system that anyone can copy as teased. Yeah. We're gonna get it going, man. I got some stuff on the floor. I got some stuff with Math on the floor. I got some stuff on the other side with in Dubai. I got my man Steve O. We got a lot of stuff going on with Bloodalytics, man. So just letting you know. Hyman said I bought raw Bitcoin at 113, no stop loss. Damn! Oh my God, Hyman out here crashing out. Only trading 10K at a time. Figured we would pull back at 111 or 115 support. I went with Bloodalytics and took the short. That's my guy. That's my guy. He at least somebody's winning. Somebody's using Bloodalytics. He took the short. Yeah, you're right. My loss is your gain, my friend. We playing zero sum right now. You took my money for sure, but I'm trying to get it back right. I hope he took your profits because I'm coming back. I'm coming back for my money. We're up 700. I'm coming back. I'm coming to get my money back. Yes, sir. Let's go. All right, let's see what Jerome talking about, man. He ain't talking about much, but hey, you're here for him, not for me, I guess.
Good assessment of what that will be. When we get PPI, there might be some adjustments, but so directionally, it was a little softer than expected, and we always break it down into the three components. So basically, you've seen goods prices increasing, and that's really due to tariffs, and that's compared to a longer run trend of very, very mild deflation in goods. So that's moving inflation up. On the other side of that, good news that housing services inflation has been coming down and is expected to continue to come down. So if you remember a couple of years ago, that's the one that we kept expecting it to do that. Now it's been doing that for some time, and we expect to continue that. That leaves the biggest category is services other than housing services, and that's kind of been moving sideways over the last few months, but a significant part of that is non-market services, and we don't take a lot of signal about the tightness of the economy from that. So if you add all that up, a couple things to say. One is that inflation away from tariffs is actually not so far from our 2% goal. We estimate, people have different estimates of what that is, but it might be, 5 or 6 tenths, and so that, if it's 2.
Come on, man. Come on, dog. Come on, man. Come on, we back, baby. We back. Give me my money back. Give me my money back. Let's go.
The base case is that it will come, and it probably will increase further, but it is that it will be a one-time increase. And, we've been very focused for all of this year at making sure that that's the case and thinking carefully about what are the pathways through which it could become something else, troublesome inflation. One of those would be, a really tight labor market. We don't see that. Another could be inflation expectations moving. We don't see that. So I think, we're watching this very carefully. I think it's not the case that we're just assuming that it's going to be a one-time inflation. We understand fully that this is a risk we have to monitor and ultimately manage.
With the stubborn in services inflation, what are some of the things that the Fed could do to address that, and especially when we're seeing potentially labor supply challenges?
Sorry, say the first.
The stubborn services inflation that you mentioned.
Service inflation, yeah. Well, again, the part of services inflation that isn't coming down as we would like it to is the non-market part of non-housing services. And, overall, that's just something that we expect will come down. The non-market part of it should come down. It largely reflects higher stock prices and financial services that are imputed rather than actually paid is a big part of that. But also just, we think policy is still modestly restrictive in my telling. So that's the kind of thing that should lead to a gradually cooling economy. That's one of the reasons you see a gradually cooling labor market, is because
Come on,
Fed policy is modestly restrictive. So that should also help get that. I want to say, though, we're absolutely committed to returning inflation to 2%. If you look at longer-term surveys or market pricing, you will see that's a credible commitment, and there should be no question that that's where we're going.
Chris.
Great, thank you. Chris Rugaber at Associated Press. So there's a big investment boom in AI infrastructure right now, as you know, and wondering if the existence of such a boom would indicate that rates are not that restrictive after all, and could further rate cuts at this point perhaps fuel an excess level of investment there or market bubbles. How is the Fed thinking about that?
So I don't think that you're right. There are a lot of data centers being built and other investments being made around the country and around the world, and big U.S. companies are just investing a lot of resources in thinking about how AI, which will be based on those data centers, run through those data centers, is going to affect their businesses. So it's a big deal. I don't think that the spending that happens to build data centers all over the country is especially interest sensitive. It's based on longer run assessments that this is an area where there's going to be a lot of investment and that's going to drive higher productivity and that sorts of things. I don't know how those investments will work out, but I don't think they're particularly interest sensitive compared to some of the other sectors.
And then just a quick follow-up. You mentioned that you do have data that you're looking at for inflation and growth in the absence of government data. Could you give us a sense? I think we know a lot about the jobs data that's out there. Can you give us a sense of what you're looking at to track inflation in the absence of government data? Thank you.
So it's a lot of things, and it doesn't replace government data, but you know all of these. I'll just mention some of the many names: Price Stats, Adobe, and others. For wage inflation, there's ADP data. On spending, you're going to ask about spending at some point. There are lots of other things that we look at, but it's many different sources, and again, including what we get out of the Beige Book, which will be sort of come out mid-cycle as always. And it doesn't replace the government data, but it gives us a picture. Again, I think if something material were happening, if there were material developments, I think we would pick that up. I don't think we'll be able to have the very granular understanding of the economy while this data is not available.
Howard?
Howard Schneider with Reuters. Thank you. I just wanted you to elaborate a little bit on what you said a moment ago about a continued shutdown, making it more difficult to make a move in December, and that may make you more cautious. To the degree you are relying on private data that isn't the gold standard, or that you're relying on your own surveys or the Beige Book, do you worry at some point you're going to have to start making policy by anecdote?
This is a temporary state of affairs, and we're going to do our jobs. We're going to collect every scrap of data we can find, evaluate it, and think carefully about it. And that's our jobs. That's what we're going to do. If you ask me, could it affect the December meeting? I'm not saying it's going to, but yeah, you could imagine that what do you do if you're driving in the fog? You slow down. So that could or could not. I don't know how that's going to play into things. We may get the data may come back, but there's a possibility that it would make sense to be more cautious about moving. I'm not committing to that. I'm just saying it's certainly a possibility that you would say we really can't see, so let's slow down.
As a follow-up in the debate on this meeting, we saw recently some pretty big layoff announcements coming from Amazon and others. Wondering if that figured into the discussion at all, that you're starting to see this tension between growth and employment starting to be resolved, to the detriment of employment. And secondly, some of the stress is starting to appear in the bottom spur of the K, as they call it, household health premiums that are going to possibly be going up quite substantially, things like that. Has that started to become a factor in your policy discussion?
So those are both things that we're watching very, very carefully. To start with the layoffs, you're right. You see a significant number of companies either announcing that they are not going to be doing much hiring or actually doing layoffs, and much of the time they're talking about AI and what it can do. So we're watching that very carefully, and yes, it could absolutely have implications for job creation. We don't really see it in the initial claims data yet. Now, it's not a surprise that we don't. It takes some time for it to get in there, but we're watching that really carefully. But again, don't see it yet in the initial claims data. On the K-shaped economy thing, I would say the same thing or similar thing. We are, if you listen to the earnings calls or the reports of big public consumer-facing companies, many of them are saying that there's a bifurcated economy there, and that consumers at the lower end are struggling and buying less and shifting to lower-cost products, but that at the top, people are spending at the higher income and wealth, and so much anecdotal data on that, and so we think there's something there.
Edward.
Thank you. Edward Lawrence with Fox Business. So, Mr. Chairman, I want to take another crack at the further reduction of rates is not a foregone conclusion. So in December, you said far from it. So if a cut might not be on the table for December because of lack of data, what does the other concerns then stem from? So if it's not lack of data, as the reason December is not a foregone conclusion, what other things could be the concern then? Well, the perspectives of people on the committee that, we've now moved 150 basis points and that we're down into, you're into that range between 3 and 4 where many estimates of the neutral rate live in that 3 to 4% area. You're there now. You're above the median number for the committee, but I think there are people on the committee who have higher estimates of the neutral rate, and that's you can argue these positions since it can't be directly observed, the neutral rate. So, I think for some part of the committee, it's time to maybe take a step back and see whether there really are downside risks to the labor market, or see whether in fact the growth that the stronger growth that we're seeing is real. Ordinarily, the labor market is a better indicator of the momentum of the economy than the spending data. That's the lore. In this case, that gives a more downbeat read. So people just have, again, we've cut 50 more basis points in the last 2 meetings, and there's a sense like, from some, let's pause here kind of thing. And a sense from others wanting to go ahead, but that's why I say differing views, strongly differing views. So on that division then you're talking about going forward, so what's more important in this division? Is it inflation risks, is it employment risk, or is there a deeper philosophy division among the board? Look, everybody on the committee is deeply committed to doing the right thing to achieve our goals, maximum employment and stable prices. You have differences on how to do that. And as I mentioned, some of that is different forecasts, but a lot of it is also different risk aversions to the different variables, which is common through all Federal Reserves. People just have different risk tolerances, let's say. So that leads you to people with disparate views. You will know that from the speeches you've been listening to from my colleagues. And so we're at a place now where we have in fact cut 2 more times. And we're 150 basis points closer to neutral, wherever that may be, than we were a year ago. And so there's a growing chorus now of feeling like maybe this is where we should at least wait a cycle, something like that. That's what it is. It's just what you think it would be. It's and again, you've seen it in the September Summer of Economic Projections. You've seen this in the public remarks of FOMC participants, and now I'm telling you that's what you can expect that in the minutes. And I'm just telling you that's what happened in the meeting.
Elizabeth. Thank you so much. Elizabeth Schulze with ABC News. What is your explanation for why the job market is weakening right now, and what will this rate cut do to improve the job market?
So I think there are 2 things affecting the job market, and one of them is just a dramatic reduction in the supply of new workers. And that's 2 things. That's declining labor force participation, which is a cyclical thing. And then there's declining immigration, which is just a big policy change that actually began in the last administration and it has been accelerated now. So a big part of the whole story is that supply side story. Okay. In addition, labor demand has declined, and so the unemployment rate has gone down, meaning that demand for workers is going down a little more than supply. So that's what's going on, but it is mostly a supply function. It's mostly a function of the change in supply, I think, and many people think. So the question then is, what does the our tool do, which supports demand, and I would just say, when you're in a situation where job creation, if you adjust for likely overcounting in the way that BLS does its work, is pretty close to 0. So maximum employment doesn't, on a sustainable basis, if you're creating 0 jobs, if it's in equilibrium, if it's in balance, it's a pretty as I said before, a pretty curious balance. So, I thought, and many of my colleagues thought, in fact, you've seen the last two meetings, that it was appropriate for us to react by supporting demand with our rates. And we've done that. We've reduced so that rates are looser. I wouldn't say that they're accommodative right now, but they're meaningfully less tight than they were. And that should help so that at least the labor market doesn't get worse. Though it's a complicated situation, and some people argue that this is supply and we really can't affect it much with our tools, but others argue, as I do, that there is an effect from demand and that we should use our tools to support the labor market when we see this happening.
You also talked about tariffs causing a one-time price increase. Should American household consumers expect that inflation will continue to go up this year because of those tariffs?
So the basic expectation is that there will be some additional increase in inflation because it takes a while for tariffs to work their way through the production chain and finally get to consumers. And we see this now from the tariffs that were put in place now many months ago. We see those effects, but if you put tariffs in effect, and they've been coming into effect consistently in February, March, April, May, and that's all happening. So that'll continue to happen for some time, probably into the spring. These are not big increases, though. These are a tenth or so on inflation. They may be big increases on a particular product that's been tariffed, but overall, these are fairly modest. I think some projections go, we're at 2.8% inflation. You might get 2 or 3 more tenths or 4 more tenths maybe. But then, as all of the tariffs are in, they stop generating inflation. You've had a one-time price increase. As long as you're not, at least this is the theory, this is how we believe and hope that it will work out. Once the last tariff is put on something, at that point, it becomes a higher price level, but it stops going up, if you will. Prices stop going up. They'll just be at that level. And then measured inflation will come back down to non-tariff inflation. As I mentioned, non-tariff inflation is not so far from 2% now. Now, consumers are not interested in that story. Their prices are higher. More than that, the reason they're so unhappy about inflation is the inflation that we had in 2021, 2, and 3. Because, you can say that prices aren't going up as much, but that doesn't mean people aren't feeling those higher prices from the inflation we had 2 or 3 years ago. They are, and that's, I think, a large part of why the public, if you sample people, inflation is still very much making people quite unhappy. Even, and it's nice that, that prices are not going up as fast as they were, but they're still much higher than they were. And it'll take some time for that effect to wear off. As real incomes rise, it will feel better over time, but that's going to take time.
Mike.
Michael Hickey from Bloomberg Television and Radio. Do you have any concerns that equity markets are or are close to being overvalued at this point?
We don't look at any one asset price and say, hey, that's wrong. It's not our job to do that. We look at the overall financial system, and we ask whether it's stable and whether it could withstand shocks, right? So, banks are well capitalized, while some households are clearly under stress. In the aggregate, households are in good shape financially, relatively manageable levels of debt. At the lower income spectrum, you are seeing rising defaults, particularly around subprime auto, but nonetheless, in the aggregate, pretty good. And you don't see too much leverage in the banking system or the financial system. It's a mixed picture, but it's not an overly troubling picture. And again, I'm not. It's not appropriate. We don't set asset prices. Markets do that.
Well, you must be well aware that by lowering interest rates, you're contributing to additional asset price increases. And I wonder how you balance the idea that lowering rates would help the labor market with the reality that it seems more likely to be stimulating increased investment in AI, which is the rationale for thousands of job cuts that have been announced in the last few weeks.
Yeah, I don't think interest rates are an important part of the AI, of the data center story. I think, people think they're great economics in building these data centers, and they're making a lot of money building them, and they think they have very high present value and all that sort of thing. It's not really about. It's not about 25 basis points here or there. We use our tools to support the labor market and to create price stability. That's what we do. That's our two jobs, right? So we're here by lowering rates at the margin, that will support demand, and that will support more hiring. And that's why we do it. Now, no 25 basis point or even 50 basis point hike is going to be a dispositive thing, but ultimately, lower rates will support more demand, and that'll support hiring over time. And of course, we also have to be careful about this, which is what we've been doing, because we know where inflation is, and we know that, I've told you the story. It's a complicated story, but this is the best assessment that we can make. Because there's uncertainty around inflation and the path ahead for inflation, that's why the pace we're going has been a careful one.
Victoria. Hi, Victoria Guida from Politico. On AI, I'm just wondering, it seems like a lot of the economic growth that we've been seeing is fed by investments in AI. So how worried are you about what a sudden contraction in tech investment would mean for the overall economy? Is there enough strength in other sectors? And specifically, are there any lessons that you take from the 1990s in how you might approach what's happening right now?
Yeah, this is different. In the sense that the companies that are so highly valued actually have earnings and stuff like that. So if you go back to the 90s and the dot-com, these were ideas rather than companies, and so there's a clear bubble there. Whereas I won't go into particular names, but they actually have earnings, and it looks like they have business models and profits and that kind of thing. So it's really a different thing. The investment we're getting in equipment and all those things that go into creating data centers and feeding the AI, it's clearly one of the big sources of growth in the economy. Consumer spending also, though, has been, is much bigger than that and has been growing and has defied a lot of, negative forecasts, continuing to do so this year. Consumers are still spending. Now, it may be mostly higher end consumers, or maybe skewed that way, but the consumer is spending, and that's a big chunk of what's going on in the economy, substantially bigger than AI. You can point to growth. I mean, actually, maybe growth as opposed to level, but consumer spending is a much bigger part of the economy.
And why do you think that the labor market is slowing so much, even though consumer spending is strong?
Why has it slowed so much? Well, what's happened is that the supply of workers has dropped very, very sharply due to mainly immigration, but also lower labor force participation. So, and that means there's less need for new jobs, because there isn't this flow into the pool of labor that where people need jobs, because there aren't those people now. So there's not a supply of workers showing up for jobs. In addition, demand has also gone down, and so has labor force participation has declined, which is more of a sign, in this case, of demand as well as trend. So I think you're seeing some softening. The economy's growing at a slower rate than it was, 2.4% last year. We think around 1.6% this year. It could have been a couple of tenths higher if not for the shutdown. And of course, that will reverse. But you still got the economy growing at a moderate pace.
Andrew.
Hey there, Andrew Ackerman with the Washington Post. I wanted to ask if you could elaborate on how you think about policy in the context of the data drought. Does it make you inclined to stick with your plans as set out in September in the absence of the data that might change your mind, or does it make you inclined to proceed with added caution because of uncertainty?
Yeah, well, we'll know when we face that question, if we face that question. It'll probably be argued both ways, right? But I've said a couple times here that, if you really aren't getting information you really don't know, and the economy looks like it's solid and stable and hasn't really changed, there will be an argument. I don't know how persuasive it will be, but there will be an argument that, you slow down when you can't see as far ahead. Others may argue, I'm not sure where this argument will come, but you're perfectly right that you could also argue, well, things haven't really changed. But you might not know that, you know. So I don't know whether we'll face this or not. I hope we don't. I hope by the time of the December meeting we're getting, you know, a better flow of data. But if we're going to have to do our jobs one way or the other.
Okay. I also just wanted to ask a FinReg question. I think several years ago you said the overall amount of capital in the system was about right. As the Fed moves forward with a revised Basel proposal, potentially changes to the GSIB surcharge, has that changed at all? Or are you planning to significantly reduce the amount of capital in the system? Thanks.
So there are discussions going on, I think, among the agencies. And I don't want to get ahead of those discussions. I continue to think that the level of capital, when I said that in 2020, was about right. And of course, there's been much capital added since then through various mechanisms. But I look forward to. I know those discussions are really just getting going. They haven't come to the point where they're got a whole plan and that kind of thing. So I really don't have much to say on that.
Brian.
Hi, Chairman Powell. Brian Chung with NBC News. Is the weakness in the jobs market accelerating, and who's at risk if the interest rate cuts are not the effective medicine for a further slowdown in the labor market?
So we do not see the weakness, as you put it, the weakness in the job market accelerating. I would say, and again, we didn't get the September employment report, payroll report, but we look at, you know, the unemployment insurance claims, initial claims are reported at the state level, and we still get those, and we can accumulate them and get the national number. And there's really, no story. You can look at the numbers. Same thing with the job openings we get from Indeed. There's just no story over the last 4 weeks. It's kind of stable. So you don't see anything that says that the job market is, or really any part of the economy is making a significant deterioration. Don't see that. You see more things like I mentioned, though, which is you see big companies making announcements of either of layoffs or of the idea that they won't need to hire. Their number of employees is not expected to go up over a number of years. There may be different people working there. They say that too, but they don't need a bigger head count. So you see those kinds of things. You don't see it in the aggregate numbers. The layoff numbers have not gone up, but job creation is very low. And the job finding rate for people who are unemployed is very low. But the unemployment rate is very low as well. 4.3% is a low unemployment rate.
So as you make these cuts, is it the lower income workers that you're thinking about, or those who might have their jobs automated? Is there a particular section of the labor market that you're particularly?
So we can't, our tools don't allow us to target any demographic or any income level and that kind of thing. I do think that people, we saw this during the global financial crisis and the long recovery. You target an income, if you have a long period of very strong labor.
You target everybody that makes above 300,000, $250,000. That's who you target. Probably even higher than that, so don't lie.
People at the lower part of the income spectrum were getting the biggest benefits, and lots of things were happening in that space demographically, which were very constructive. And we're not at that place right now. But so, a stronger labor market is the best thing we can do for the public. It's also part of our job. It is half of our job, but it is absolutely the best thing we can do for people. Along with keeping prices stable. Those two things. Inflation also hurts people on fixed incomes more than other people.
Courtney.
Hi, Chair Powell. Courtney Brown from Axios. As you know, the 12 Reserve Bank presidents' terms are up for renewal at the end of February. I'm wondering if you can give us a timeline for when the board will consider those reappointments and whether we can expect everyone to be re-upped or if we can expect some changes.
So it's a process that we go through under the law. The way the law works is we have a reappointment process every 5 years for all of the reserve, each of them and all of them. We're in the middle of that process, and we're going to complete it in a timely way. And that's really all I can say.
Okay, thank you.
Daniel.
Daniel Davis, Agence France Presse. You've now had dissents in 3 consecutive FOMC meetings, but in this meeting you had dissents going in both directions, and you've just mentioned there's strong disagreement over the future path of rate cuts. Have these disagreements complicated your role presiding over the FOMC meetings, and if so, how?
I wouldn't say that, no. I think you have to take what comes, and what comes right now is a pretty challenging situation where we have, first of all, we have 4.3% unemployment. We have an economy that's growing close to 2%. So, overall, it's a good picture. It's a good picture. But in terms of our policy, we have upside risks to inflation, downside risks to employment, and this is a very difficult thing for a central bank because, one of those calls for rates to be lower, one calls for rates to be higher. We can't do both, so we have to balance the two. And so it's a challenging thing, and as we have worked our way through this process, you would expect that there would be a range of views across the committee on what to do and the speed with which we should do it. And that's what we have. That makes a lot of sense to me. All of these people are, people who take their jobs very seriously, work very hard at this, and just want to do what's right for the American people, but they have different views on what that is. And, it's an honor to work among people who care that much. It is, but I don't feel that it's unfair or anything like that. It's a time when we're making quite difficult judgments in real time, and I believe we'll get through this. And I think we've done sort of the right thing so far this year. I think it was appropriate for us to be careful about this. I think it would not be appropriate to just ignore or assume away the inflation issue. At the same time, I think the risk of higher, more persistent inflation has declined significantly since April. And if we do wind up resuming rate cuts at some point, we will at some point. I think we're trying to get to the end of this cycle with the labor market in a good place and with inflation, on its way to 2% or at 2%. So that's all we're trying to do, and we're doing it under, quite challenging circumstances and doing the best we can.
We'll go to Jennifer for the last question.
Thank you so much, Chair Powell. Jennifer Schonberger with Yahoo Finance. Both regional and large banks have taken losses on loans given delinquencies on subprime auto loans. JP Morgan CEO Jamie Dimon warned, when you see one cockroach, there may be more likely. I'm curious how the Fed is looking at these loan losses and if it poses risks to the financial system or the outlook for the economy. Is it a warning sign?
So, we're obviously, we watch these things very carefully, credit conditions very carefully. You're right. You've seen rising defaults in subprime credit for some time now, and now you've seen a number of subprime credit, automobile credit institutions having significant losses, and some of those losses are now showing up on the books of banks. We're looking at it carefully. We're paying close attention. I don't see at this point a broader credit issue. It doesn't seem to be something that has very broad application across financial institutions. But we're going to be monitoring this quite carefully and making sure that is the case.
And then separately, many, you yourself have said that we're in a bifurcated economy right now with high net worth individuals continuing to spend with the lower income pulling back. How much of consumer spending continuing hinges on the stock market remaining strong? In some odd way, does the market help keep the economy buoyant?
So there's some relationship there, but remember, the more wealth someone has, the lower an additional dollar of wealth matters. So your marginal propensity to consume declines quite dramatically as you reach levels of stock market wealth. So, the stock market, it would affect spending if the stock market went down, but it wouldn't drop sharply unless there were quite a sharp drop in the in the stock market. People at the lower end of income and wealth have a much higher marginal propensity to consume of an incremental dollar of income or wealth, but they don't have the stock market wealth. So I think it's certainly a factor supporting consumption right now. But you would see it if you saw a material correction in spending, but it wouldn't be. You shouldn't think that it'll dollar for dollar stop consumption, because that wouldn't be the case. Thanks very much.
All right. We all done here, ladies and gents. Finally. Good God Almighty. So basically what happened is he made the markets upset with the December rate cut is not a foregone conclusion. So that really spooked the markets big time. We saw the drop. I got slaughtered on the drop because I was long going against Bloodalytics. Should have listened to Bloodalytics, but I was able to recover. I did phase out of that trade. I longed again at the bottom. See if I can bring this up. I longed again at the bottom, and I was able to get about $780 back off that $990, but basically a $1,000 loss earlier. So I got 700 and some change back. That's good. Lost only $200. I'll take that. Yesterday we again bagged in about 5K on that short, another $700-800 on that Bitcoin short. And it's been cool, man. I haven't had a chance to really trade last week because of my dad being out of commission. So, you know, it's all good. But the week before that, I was able to bag in about 3K and then another 1,100 on Ethereum, 3K on a Bitcoin short, 1,100 on a Ethereum long. So we good. We sitting good, ladies and gents. We sitting good for October. It's been an October for me, for sure. It's been an October for me. Honestly, why do we still call them smart money? We call them smart money because they control the money. You know, they control the direction, honestly. So the game is rigged. The game is rigged. Did I buy Trump coin? I haven't touched Trump coin in some time. It's been 5 months. Something like that. It's been some while. It's been a long time, man, since I messed with Trump coin. Poor people do have stocks in their retirements. Yeah. Shout out to Peacemakers. I didn't get a chance to see the no limit cash money versus. I heard Wheezy wasn't there. Yeah, Wheezy wasn't there. And yeah, I didn't see it, guys. But at any rate, I was able to get back a lot of that. I actually sold because one of my indicators, Bloodalytics, is not a live one. This is one I'm testing. It's a skunk works, but we went short on Ethereum and we closed our Bitcoin one. So we closed the Bitcoin. That's why I went ahead and closed that long on Bitcoin. The one I bought at the bottom here. I closed that long up here with the signal from my skunk works chart. So that was my reasoning for closing that out. Will we roll over? Who knows, man. Markets were definitely spooked by that. December might not get a rate cut. And, you know, he's only saying this because Trump is in office. Like if Biden was in office, this guy would have cut 155 times. He would have cut 11 times, ladies and gentlemen. He would have cut so much. You would have thought he was watching a porno or something, man. This guy would have been all up in the cut. Pause. The house always wins. Should have gone with your Bloodalytics, Scalpalytics all the way. Yeah, but I was able to recover some of that money, bro. I had to work hard for it. Is he still speaking? I need more drop again, please. No, he's done. No, I think Trump coin would go the opposite way. It would tank. Yeah, what y'all think about EBT getting shut down on this November 1st? I said I think Washington will get their act together. More so the Democrats. They're the ones that are holding this up. It's so funny. I heard the Democrats are still taking their paychecks while the Republicans are opting out for their paychecks, which is honorable, if I can call it that. Call that side honorable. But I think they're going to go ahead and get it together by November 1st or at least like the 2nd. Ain't going to let it bleed too far up into November because If people are not able to get their money to buy food, my guy, it is going to be chaos in the streets. And they don't want chaos. They don't want no instability. They don't want that. Yeah, 50-11. 50-11, my man. 50-11. If that first of the month, yeah, man, that's not gonna go over too well for a whole bunch of people. So I don't think they're gonna allow the government to stay shut down too much longer. Maybe a day or two into November, but I can't see it going any further, man. People need their money to eat. You start messing with people's food, that's when you're gonna have a real civil war. You're gonna have some real craziness going on. Yeah, crime will be everywhere, like Wisdom Bar says. It's gonna, yeah, they don't want that. Hyben says he thinks it's gonna end around the 15th. I don't think we can wait that long. I don't think we can wait that long. But at any rate, what you need to not wait for is bloodalytics.com. Go ahead and join the team, ladies and gents. Sign up for Scalpalytics Pro. We'll have some more swing trading systems on deck. The Moonalytics is a lunar swing trading system, but we'll have more swing trading systems on deck very soon. Scalpalytics Pro, Bitcoin, Ethereum. We got SUI, XRP, ESA, Solana, and BNB on deck. Come join us, man. You would have made money if you would have listened to it today. I didn't listen to my own signal. But we are turning over. So I did get most of my money back before getting out. That look, we're dropping now. Ethereum's dropping big time. Bitcoin's dropping big time. We got out of that trade because of the signal telling us to close that long. Look at that. Look at that. Let's just scalp. This is the 1 minute. Starting to roll over. Hope y'all got out. Because I did. Got in and out. My job gave out $150 in Publix gift cards to 150,000 employees. Oh, wow. That ain't going to do shit. A week's worth. Guess ain't no one waking up to the cash their checks and get up. But this is all going to according to the plan for the elite to force the Insurrection Act and bring on full Patriot Act 2.0. House of Trades making that money. We printing, baby. That's right. We printing. Come join the print team. We can be like you could be like Jerome Powell and print the money. Print the money. All right, y'all. I'm out of here. I'll check y'all in the morning. Normal live stream, 11 o'clock a.m. Eastern Standard Time. Come join me there. We'll be printing some more money, hopefully. All right, your boy Crypto Blood. I'm out of here, people. Holla.
Yo, it's Crypto Blood, Detroit flow, screaming from the D, knowing what to show. Indicators are wrong point, OG since 12, invested in trade, living life like a pro. I'm Rucker, Jerry, and just Bloods do. Bad motherfucker in a good way, boo. Got my eyes on the charts, ain't no time to sleep. Get that money, gotta keep it creep. That's my Crypto Blood, twist the toasters on the line. Stacking my coin, got the market on my mind. Bitcoin, Litecoin, Ethereum too. Cash is king, but I'm looking for a new move. I know the culture of the markets like the streets. Got my finger on the pulse, can't nobody beat. I see the trends, I see the flow. Got my strategies in place, you know.
Stacking my coin, stacking my coin, stacking my coin, stacking my coin, Bitcoin, Litecoin, Ethereum, cash, Bitcoin, Litecoin, Ethereum, cash, stacking my coin, stacking my coin, stacking my coin, stacking my coin, stacking my coin. Litecoin, Ethereum, cash, Bitcoin, Litecoin, Ethereum, cash. Since I was born, been stacking my coin. These niggas pop, my money keep growing. Your girl is a dot, she all on my groin. She blowing my horn, we fuck like porn. These rappers is whack, they lyrics is corn. I'm getting this money, it never get born. I'm loading my strap, they calling law. Fuck around and get clapped for running your jaw. If it ain't about the dollars and it don't make sense. Got me sipping brown water, but it ain't from Flint. Trying to chase all this bread, though the shit won't last. About to shut the city down like a crypto crash.
Fuck it. Do it live. I'll write it and we'll do it live.
Okay. Ready?
Fucking thing sucks. We'll do it live.
Okay.